So we are trying to figure out what oil's message is. If you look at the price action, I mean, up 1.5% is not a whole lot. What do you think it's telling us?
Yeah, so I think oil's telling you two things. First, it's telling you it's not going to rally on supply-driven events. And you touched on a couple of reasons why. The first, obviously, we have a ton of spare capacity sitting on the sideline from Saudi Arabia and the UAE. They are literally chomping at the bit to bring back more production. So any supply event has a buffer to it because you have spare capacity. The second thing I think that the market is telling you is, again, you mentioned it, we're looking at 2024 and we're concerned that the market is actually going to end up being oversupplied. And the reason the market's so worried about this isn't that demand is going to get cratered. We're looking at demand growth next year of around 1.5 million barrels a day. It's not a terrible number, but what we saw in 2023, which was the surprise of the crude market, was incredible production out of the United States, well above our estimates. We're estimating coming into this year that U.S. production is going to grow at 700,000 barrels a day. We're at 1.1, right? So if we get another year where U.S. production vastly outperforms estimates, which estimates are looking for 500,000 barrels a day of growth out of the U.S. next year, but we get that incremental efficiency, productivity like we saw this year, you get a market that's even more oversupplied. So I think it's more of a supply story going into 2024. There's a lot of fear that no matter what OPEC does, no matter how much they cut, there are producers, non-OPEC producers, that are just going to fill that hole. They keep digging. So ultimately, I think that's what the market's telling you. As it relates to the Suez Canal, one important thing, you noted it in the lead up. The biggest increase of flows through the Suez Canal has been by Russia. They're shipping their barrels to India and China. It's very unlikely the Houthis are going to target Russian crude. The Iran-Russian relationship has been getting stronger and continues to be strong. So although that headline number, 8% of demand's at risk, it's much smaller because they're not going to target a Russian ship. Lastly, the task force is in place. I think that gives a little bit of confidence. I agree, you got to question the ability of that to act. But I think all of those things, all in all, crude's looking at it and saying, I don't chase supply-driven rallies. I chase inventory drawdowns and I chase exponential demand growth.
So we saw a real surge in European natural gas prices on the back of this, Rebecca, and I'm wondering if you think that keeps up. And I'm thinking about this as a piece of the puzzle of the European Central Bank, what it needs to do and how it's trying to fight inflation.
That's a great point. So although crude isn't reacting to this, you're right, nat gas is. And the problem there is they don't have a lot of alternatives for their nat gas flows. So that is actually where you will see probably continued impact if this isn't resolved and if we have to reroute the extra 2.5 weeks around the Cape of Good Hope, right? So that is a real impact. The other place the market is assigning real risk to it is in diesel and in products, again, into Europe. We saw crack spreads up 8% today, and they're going to hold because Europe can't just look to Russia to backfill those products. It's not like crude oil where it's as fungible and it's easy to access. So you probably will see longer lasting impacts in gas and in products where there isn't that massive spare capacity or readily available alternatives.
All right, Rebecca, thanks for joining us. Rebecca Babin, CIBC. All right, so now knowing and understanding that the real risk is to the European energy markets, Tim, I'm wondering if that changes your outlook for Europe at all.
Again, I don't know how long this risk lives on. You had a very weak EFO number in Germany, which is their kind of state of the economy. After 4 really solid months, we've seen the DAX at all-time highs. I think relative value, it gets back to, again, relative to itself, the DAX is actually kind of attractive here. Do I think Europe's running away? No, I think their economy is going to be weaker than ours in the coming 12 months. But I don't think this is a headline. Remember what Europe had to endure with Russia and what was going on there in terms of gas prices and the inflationary impact.
Yeah. Do you like energy here?
I love energy. I think energy is a long-term core holding. I mean, I look at companies like the majors. I mean, you're getting a great dividend yield. You're getting inflation protection just in case we're not out of the woods on inflation. I feel like it's basically tips on steroids. It's got, you know, kind of everything that you want in your portfolio as a ballast. And then I think that on top of that, these companies have finally gotten religion around supply discipline, around cash return and capital allocation. They're no longer paid on production targets. So I think these are all really positive themes for the energy sector. And it's very under-owned at this point in the year because it's done pretty poorly all year. So I think there's upside just based on ownership as well.